It's Thursday, January the 27th, and we're almost have the first month of the year in the books. And what
Are we going to be glad
well,
it's through?
I think we'll be glad January's over, but
Yeah.
that doesn't necessarily mean that when the calendar turns to February that things are going to be back to normal. We anticipated having a correction. We talked about it on one of our weeklies, and
Here we are.
Here we are.
Here
We
we
are
are.
in correction territory. The S&P is off right at 10%, which is correction territory. And we expect that we're going to continue to have very volatile periods of time. But again, we would both say that at the end of the year, we expect to be up.
Let me say that we've had a steady flow of phone calls this week, and we appreciate those, and we're grateful for those. And we will encourage you, if you are concerned or want to have a conversation, to call us. We have also sent out an email, or it's in the process of being approved by compliance.
We sent one earlier this week,
right, and we're working on another one right
because
now.
we made other changes a couple of days ago.
Monday morning, we had meetings. We described to a client, several clients we've talked to, that we went into meetings Monday and we put a game plan together, and we identified areas that we anticipated that would react to what happened this week, but it reacted a little more than we did. So we have made moves to eliminate those areas to free up some cash, and we have made a even bigger move in decision in that right now, from a cash position, we might want to carry a little more cash than we normally do, because even though cash is not going to give us a earnings in a short period of time, it's not going to give us any volatility.
That's correct. It's the lowest it's the lowest score on our risk-alize. So cash registers a 1 on a scale of 99. So we're trying to have our portfolios be much less volatile. The cash is going to do that. We got out of some assets, even on the fixed income side, that we feel that with interest rate increases at 3 or 4 times this year are not going to react positively. So we would rather be in cash. And then we're in search of and doing a lot of research on maybe where we would move some of that cash to put back to work.
In addition to that, with the cash that we came out of, one or two of the equity positions that we felt like carried too much volatility, we are looking for opportunities to buy because things are on sale. So we are, in some cases this week, we've already made some buys, and we are looking to buy into this dip. One of the most amazing statements I heard from a very large money manager yesterday is that he said he made a buy into a very big position, and he says he did it because this market has created a great opportunity. It presented an opportunity for him to buy at a discount. And so that's what we're looking at for you also.
And it doesn't mean that it's going to be further discounted over the course of the next month or so. But we are not market timers, and we've said that to you many, many times, but we are market opportunists. So we look for things that are less expensive than they were even 30 days ago, and in many cases, much less expensive. So those are the areas we're focused on in enhancing your portfolios.
Now, yesterday, the Federal Reserve Chairman had a conversation and talked to the market and the press, and in effect, he really was not specific. And so by not being specific, by being vague, and we all know he's going to increase interest rates. We all know that tapering is going to occur, but we don't really know how much and when. That created uncertainty in the market, and the market doesn't like uncertainty. So we'll work through that issue that we're dealing with. We all are aware of the Russian-Ukraine issue. We'll have to work through that. And then you have China, Taiwan after the Olympics, and we'll work through that. So it's a busy time for us, but we're here prepared to do it. We're looking at things. We're ready to have conversations, but we feel good about it. I tell you what I feel the best about. If in the month of January, the Dow and the S&P were down in the rough range of approximately 10%, our portfolios on average we're off only about 4 to 5%.
Yeah, and that means your portfolio is doing what it's supposed to do.
That's correct.
I mean, we design our portfolios for, in most cases, for our rank and file clients that fall into certain risk categories to underperform when the S&P is up, but to overperform when the S&P is down. And that's what your portfolios are doing.
So call us if you have concerns or questions. We're looking at it. We're talking each and every day. We have plans in work. We're here. We will love to talk with you. Call us, but know that things are going to be okay, and we're looking towards the end of the year with an upside view in mind. But always remember, it is your money.
And your money matters.
See you next week.